Okay, so hi people, what we're going to do today is we're going to complete chapter 11. Okay, chapter 11, which the last part is capital rationing. Okay, so what is capital rationing all about? What do you do in capital rationing? What does capital rationing deal with? All would be discussed in chapter 11. So let me okay, so this is our final part of chapter 11, okay, which is capital rationing. So what are we going to do in capital rationing? What will we talk about in terms of capital rationing? So guys, please remember, every topic that we do, there is an objective, okay, of why we do it. So when we talk about this topic, which is capital rationing, what I want you to remember is that in this area, capital rationing actually means the company does not have sufficient or does not have enough money or enough capital or enough funds for them to run their day-to-day operations or for them to take on their investments. So of course guys, you know that when it comes to capital rationing, what happens is that there may be a limitation of funds for the company. So why is there a limitation of funds? Why do you have a limitation of funds? The reason why there is a limitation of funds is because the company may choose to do so, or this limitation may arise due to external reasons. But of course, again, I know that some of you may argue, but miss, isn't it better for us to take on a lot of projects? Yes, of course. The company's objective is normally to take on all the project with a positive NPV. How and why do you want to do that normally? Because when you take on projects with positive NPV, what is the outcome or what is the feedback? The outcome of the feedback is that the company will be able to obtain a higher profit if you take on projects with positive NPV. But guys, then again, I may ask you back a question. How if the company is just taking on projects, even though they are profitable, they may not be suitable for the company's they may not be suitable for the company's approach. They may not be suitable for the company's ability to take on the project. They may not be suitable in the long-term generation of funds for the company. So in that case, right, what you want to do or what you want to ensure is that you want to ensure that the company is actually taking on projects that are highly effective and highly efficient. All right. So in order to do so, the company will not only ensure that they take on such projects, but they will also try their best to ensure that these projects are actually highly effective and efficient, that will increase the ability of the company to generate profit, and effectively you will be able to earn a positive NPV, right? Effectively, in the end of the day, remember our ultimate objective is to ensure that the company will be able to maximize shareholders' wealth. All right. So what are the types of capital rationing that we have? So the types of capital rationing that we have is that two types. Number one, you have soft capital rationing, and number two, you have hard capital rationing. Soft capital rationing is also known as internal capital rationing, okay, or you can also say that it's often used as it arises due to internal reasons. And hard capital rationing normally arises due to external reasons. Now, So when I say soft capital rationing is usually the situation that is brought by the decision of the management of an organization to purposely create a limitation on capital or funding for the organization. The next one, you talk about hard capital rationing. What is hard capital rationing? Hard capital rationing, it arises due to external factors, whereby this hard capital rationing will limit or is a limitation that arises due to external factors. Example, the bank does not want to provide your company a loan. So that is an external capital rationing. That is an example of external or hard capital rationing. So you guys, you must know these terms interchangeably, because examiner can use soft capital rationing, or he can use the term where he says capital rationing arising due to internal factors. He can say either one. All right. Now, why does a soft capital rationing or a hard capital rationing arise? Okay. Soft capital rationing is arising or may arise due to the company not being willing to issue additional shares. Why? When the company wants to issue additional shares, so the concept here, guys, is like this. You want to raise finance. In order for your company, let's say your company is company A. When you want to raise finance, what you do is you sell shares to investors. The investor will give you money. All right. Now, what you want to do is, okay, what the company wants to do is they want to remain the control within the existing shareholders. So they do not want to increase the amount of share capital, because they fear that increasing the share capital of the company may dilute the ownership of control. Ownership or control. Okay, so they do not want outsiders or people outside the organization to gain control over their business, right? So that's reason number one. Reason number two, the reason why the company wants to limit the investment, okay, is because they may want to use their internal funds. That means they want to use whatever funds that they already have in the retained earnings of their company. So when you use the retained earnings of your organization, what is the advantage? The advantage is that you get to reduce the transaction cost of raising any finance. Because as you know, guys, when you raise finance via debt, or when you raise finance via equity, the problem that mainly arises for a company is that this will increase the transaction cost for the company. So you want to reduce the transaction cost, so you use the retained earnings to fund your investment. So when you use retained earnings, you don't want to overuse it in such a way your company does not have retained profit. So you will control the amount of investment that you have and the value of the investment as well. All right. Next, the reason why the company does not want to raise finance via external finance, example, via a debt finance, is because the moment you have a debt finance, okay, you increase your debt finance, what happens is that this increases the gearing of the company, the financial risk of the company. And as a result of increasing the gearing and the financial risk of the company, what happens is that this may, in the longer term, if your financial risk is too high, it may lead to the company going through liquidation issues or also bankruptcy risk. But guys, please remember this. Whenever you talk about increasing your debt capital, not necessarily it will lead to a bankruptcy risk. Okay, not necessarily. Maybe when you increase the debt capital, besides the most crazy impact, which is the bankruptcy risk, the least impact is, or the smaller, or the smaller view of the impact of issuing debt capital, is that it may reduce the debt capacity of your company. What does it mean by debt capacity? Debt capacity means the ability of your company to borrow more loans. So the higher the ability of your company to borrow loans, that means the more you can borrow. But if you have used up that capacity, you have borrowed too much money, then your debt capacity will slowly reduce to an extent where banks will not give you or will not pay you loans, not pay you, won't give you, won't enable you to borrow money. Now, you also need to remember, guys, that as a result of issuing additional debt, it will also lead to the company suffering from lesser profits. Why do I say the company suffer from lesser profits? Because when the interest obligation of your company is higher, that means the fixed cost that you pay will be higher. And the higher the fixed cost, the lower the PAT. Why? Because you have used all your profit to pay out your debt holder. Now, the risk of the equity holder is much higher. So please remember that. Please be aware of that. Please be careful of that. Now, the next one, okay, this actually should be relevant to the share capital. Okay, it's maybe an additional point that you can add to the share capital. When you issue additional ordinary shares, what happens is that besides the management not willing to issue shares due to other people gaining control, that means outsiders gaining control, another problem is that there may be a dilution in the earnings per share of the company and also the dividend per share of the company. Now, when there is a dilution in earnings per share and dividend per share, will you be able to maximize shareholders' wealth? No, because maximizing shareholders' wealth means paying them a higher return. But now when it's diluted, it means that each investor is earning lesser per share that they hold. So that is not a good indication. Okay, so that is the reason, those are the reasons why soft capital rationing may arise. Now, the next one is hard capital rationing. So what is the reasoning for a company to go through hard capital rationing? Okay, so the company may find it difficult to raise finance from external parties due to, number one, maybe there is a restriction that is placed on the company, or there is a restriction that is placed on the ability to earn, all right, not earn, to lend money, because the government has a restriction. That means based on laws and regulations, they have said that you cannot borrow, or if you want to borrow, you need to meet certain criteria. So that may be a reason why you are unable to borrow money. Now, besides that, sometimes because your company is very small and you don't have a proper track record, when I say don't have a proper track record, that means your company may not have been making enough profits in the past. So when you're not making good profits in the past, the bank is skeptical on whether or not they should give you this borrowing. Because in case if they give you this borrowing and you are unable to make that payment, that will be difficult for the investor, for the bank, sorry. So besides having a no track record or lesser profits, sometimes your company is also too small in such a way where you are unable to you do not have sufficient assets to cover all these investments. When you do not have enough assets to cover the investment, okay, and not the investment, the loan, to back the loan, then the bank may also not want to give you a loan. Okay, now the next one, all right. There may also be problem sorry, there may also be problem for the company to raise new finance via the stock market because the share price might be low or very less or has depressed. Okay, what that means is that no one wants to buy your shares because the share value is decreasing, and that indicates that if your share value is decreasing, the company probably may not be doing well. So that's why you may not be able to sell your shares to a third party. You may not be able to sell your shares to new investors because it is not attractive enough, okay, for people to want to purchase the company shares. And finally, the reason why you may have to go through this problem of hard capital rationing is because the bank may seem that your company is highly risky. Example, maybe you already have a loan where it has increased your financial risk. And as a result of that, the increase in financial risk may have affected your organization in such a way where the bank sees your interest obligation as too high and they are not willing to give you this loan. All right. However, due to certain reasons and certain considerations, okay, there may be a relaxation that the company may give on the capital constraint. Okay, example, a company can limit the hard capital rationing effects, and they can exploit new opportunities by looking for joint venture partners where the joint venture is willing to contribute capital and they are also willing to share a project with the company. That means you don't go and look for money from the bank. What you do is you seek another company to join your operations and then provide some capital to your company. Besides that, what they can do is they can contract out certain portions of a project in order for them to be able to reduce the initial cost of the project. So let's say the initial cost is 5 million and you can divide the project into 3 parts. What you do is you contract out one part to a different investor with the hopes that this investor will take on that project and will reduce your initial investment, and at the same time you are still able to take on the project. All right. Besides that, the company can also seek for alternative sources of finance. That means if debt is something that you cannot get and you want to avoid using equity, you can approach a venture capitalist. The venture capitalist may be able to help you source for this finance. All right, they can fund your company's project, okay, and provide you with the fund that is required. Next, the company can also use a sale and lease back arrangement, okay, because during a sale and lease back arrangement, what happens is your company sells an asset that they currently have and they get the amount of capital available and use it for their investment. And they can also use government grants, okay, as an aid, okay, to support your company. Besides all this, finally, the company can try to manage their working capital or any kind of capital, long-term or short-term capital. Now, let's focus on long-term capital. So, not working capital, can manage their capital more effectively so that they are able to use it in a more appropriate manner. All right. Now, so, guys, I'm just telling you what is it now, and then later on, I will go through the notes again, right? Now, the next part where we need to focus our attention is we are going to learn about capital rationing. So, I want you to remember that capital rationing can be divided into two types, which is a single period capital rationing and also a multiple period, if I'm not mistaken, okay, capital rationing. But for the purpose of our examination, we will only look at the single period capital rationing because that is what is normally tested in our exam. Our examiner has stated that he will only test you single period capital rationing. So, what is single period capital rationing? What does it mean? How does it work? Okay, so let's talk about that. Okay, so guys, when a capital rationing occurs in a single period, okay, what normally we would do is we will identify or we would rank our project based on the profitability index. All right, so I'll teach you about that. So normally, when we rank our project based on profitability index, the concept that you need to understand is that normally we will choose the project with the highest ratios. Now, so when we do a single period capital rationing, it also means that we assume the capital rationing is only for a single period, okay? And at all other times, your project capital is freely available, all right? What are other assumptions that we also will make when we talk about the single period capital rationing? Other assumptions are example, right? If there is a project, right, which has not been undertaken, this is actually a loss to the company. Okay, so what you do is you assume, okay, when the company does not accept or undertake the project, okay, during a period of capital rationing, the opportunity will be lost. Okay, that means the opportunity of carrying out the project will be lost. So you also assume that these projects cannot be postponed because you already lose the opportunity to carry out the project. Hence, you already you cannot postpone this period. You must take it on within that particular period or it doesn't come back to you. The next one, okay, you definitely have a direction, okay, towards the outcome of each project. That means there isn't any uncertainty that is attached to the project outcome. If they say that there is a profit that you will earn, an NPV that you will earn of 5.6 million, confirm you will earn 5.6 million. There isn't any uncertainty attached to that particular outcome. And when you are using a single period capital rationing, you also assume that projects are divisible, right? So what it means by projects being divisible, it means that the project can be undertaken in parts, okay? It can be undertaken in parts. When you say it can be undertaken in parts, that means, let's say the project value is worth 10 million. You only undertake 50% of the project, which is 5 million. Hence, the profit that you will earn on that particular project is only 5 million. All right. So as a result of that, what you normally will do is, because when your projects are divisible and can be taken in parts, what you want to do is you want to find the most profitable project that your company offers, okay, or can be undertaken. So when you find the most profitable project, what you do is normally you will take on those projects that are most profitable first, and then subsequently only you will take on the projects that are least profitable. Okay. However, guys, please remember, for as long as the projects are not mutually exclusive, there is no issue. But the moment your projects are mutually exclusive, what happens is that, let's say the two mutually exclusive projects are the most profitable, you only can choose one. Why? Because mutually exclusive means as a result of taking on one project, you are unable to conduct the other project or unable to carry out the other project. As such, what you need to do is you need to choose which project you want. And when you choose which project you want, you must remember that the project that you choose must be the most profitable project. You let go the one that is less profitable. All right. Now, when you rank your project based on the profitability index, you must remember that profitability index is calculated using NPV over your PV of cash flow. Okay, let's go and double check. Okay. PV of cash flow over initial investment. This is your PI. Okay, sorry for that. The formula for profitability index is PV of cash flow over initial investment. So what are you actually calculating? So cash inflow divided by cash, the investment that you put in. It means that the amount of money that you spend, all right, for the project, as opposed to the amount that you earn, right? So you are actually calculating the profitability of the project as a result of, or as a percentage of, or not percentage, as opposed to the amount that you invested. So the higher the PI, the better, because the higher the PI means the more profitable your project is, right? Now, remember, when calculating the PV of cash flow, please remember that the examiner sometimes he may trick you. He may not directly give you the PV of cash flow. He may give you the NPV and initial investment, and he asks you to calculate the PV of cash flow backwards. All right. So remember, initial investment plus PV of cash flow is equals to NPV. So PV of cash flow is equals to NPV plus IM. All right. So I just want you to remember that sometimes the examiner may confuse you by doing this. I don't want you to fall for his trap. Please check properly whether he has given you PV of cash flow or NPV, and then you determine which one you calculate and how you do it. All right. So now back to my explanation. Okay. So whenever you want to decide which project or what is the best combination of projects that you can undertake for your company, you need to follow 3 steps. Step number 1, you calculate your profitability index. Step number 2, you rank them from highest PI to the lowest PI. And finally, you calculate your optimum investment schedule. So this one, I will teach you how to do it in the tutorial later, okay? Or the lecture example, because I don't want to talk about it, but you are unable to understand it, all right? And After that, you can identify what is the highest amount of NPV that your company has earned. All right. Now, there is also another type of project, the non-divisible project. Okay. So, why do you need to calculate the non-divisible project, or how do you do the calculation for the non-divisible project? Right. For a non-divisible project, okay, it is still within the single period capital rationing, all right? But you cannot use the three steps that I taught you just now. That means you cannot use your step one, calculating PI, step two, ranking it, and step three, optimal investment schedule. You need to use a completely different methodology, which is you first identify the combination of projects that will give you the highest amount of NPV. You must remember, guys, since this is a non-divisible project, you cannot carry out this project in parts. Why you cannot carry out this project in parts? Because the property is you either take on the whole project or you don't take it on at all. It must be carried out by one company. So when this happens, what you do is you look at the combination of projects that will give you the highest NPV. At the same time, you don't burst your initial capital. That means you don't exceed the amount of capital that you need to ration from. So actually, when you use or when you are doing the non-divisible project, you are actually just using a trial and error method. There isn't a step for it. Okay, you just choose the combination of projects that will give you the highest NPV. Now remember, I keep saying the combination of projects with the highest NPV. Okay, now since you guys are aware of non-divisible and divisible and also profitability index, let's discuss a little bit. Oh, sorry, I lost my screen. Okay, let's discuss a little bit on what are the problems relating to profitability index. Okay, the problem number one is that you can only use the profitability index for a divisible project. You cannot use it for a non-divisible project. So you are actually not taking into account all or the entire project that is given by your, that is offered to your company. Number two, sometimes when you use a very simplistic selection criteria, you may not take into account of the strategic objectives and direction of the organization. So that's something that you want to avoid. And when you use the profitability index, another problem that arises is that it ignores the size of the project. That means even though the project has a very high index, the project might be relatively small. It's just that the profit that you earn as a result or as opposed to the initial investment is high. But the project may be actually a very small project. So those are the kind of things that you need to be aware of. Okay, you need to focus your attention to. All right. Now, with that, I've actually completed the explanation for capital rationing. I've also completed the explanation for soft capital rationing, hard capital rationing, okay, and also the methodology. Now, guys, let's quickly go through this slide here, okay, and highlight whatever is important. So capital rationing is placing restrictions on the amount of new investment projects, okay? Or you can say that capital restrictions is restricting the amount of capital or restriction on the amount of capital. because sometimes it's from internal, sometimes I'm just going to erase the whole thing and rewrite it here, sorry. Okay. Restriction on the amount of capital available for projects. Okay. Now, or you can use the word limitation as well, right? Now, usually a company undertakes all the possible NPV projects. Yes, like I mentioned this now. Of course, you want to take on all the projects with a positive NPV, but sometimes it may be good for the company, sometimes it may not be good for the company, because another reasoning is because sometimes the managers would want to take on these projects just to fulfill the short-term criteria of profitability. Let's say they take on the project, they know in the next 2 years confirm they can earn a profit, but they haven't assessed the long-term ability of the company to generate profit. So what you need to do is you need to not take on too many projects, because sometimes it may not be fulfilling the criteria of your company. Right? Now, the types of capital rationing: soft and hard, right? So internal reasons, the company poses its own capital rationings, probably to keep gearing under control and all other points that I mentioned just now. These are due to external reasons, and this may be due to the capital market imposing the limitation of funds. So here, reason: the company prefers slow organic growth. That means they don't want to be acquired, they don't want to acquire, they don't want to merge. You want to grow by yourself. All right. You don't want dilution of control. You don't want very high finance cost of obligation. Here, high business risk, political and financial risk, and the information relevant to the company is much lesser. Okay, so this explains A to Z on capital rationing. So what you should do next is, okay, what we are going to do next is, we are going to do a short question. The question would be project E. This project E will be available in your this project E will be available in your compilation. We will do the part where we will do the part where it relates to capital rationing. All right, so there is one part where it relates to capital rationing. All right, now so project E, it's a June 2004 question. Let me just open my question, guys. Okay, don't worry, you have it in your compilation. All right, or you can even use your own past year compilation from your revision kit, or you can use your past year compilation from the one that is provided to you by your respective lecturers. Okay. Okay, so you can see that this question is a fairly important question for capital rationing. I've used it before. Okay, now all right, here he asks you to calculate the maximum net present value. So calculate the maximum net present value which can be obtained from investing the fund of 10 million, assuming here that the nominal after tax NPV of project E is 0. So he assumed that this NPV is equals to 0. Okay, let's read the question together. The board of OAP has decided to limit investment funds to 10 million for the next year and is preparing its capital budget. The company is considering 5 projects as follows: A, B, C, D, E. All 5 projects have a project life of 4 years, Project A, B, C, and D are divisible. Divisible means can be carried out in parts. And project B and D are mutually exclusive. So guys, remember when I taught you about mutually exclusive just now, what did I tell you? I told you that if you have mutually exclusive projects, you need to choose the project with the highest NPV. Highest PI. Okay, you need to let go one. You don't have a choice. All right. Now, Project E is a strategically important project, and the board have decided that it must be undertaken in order for the company to remain competitive. So, whether or not your ranking is high or low, you need to take on this project. Project E will always be taken on, so it will be ranked as number one. So, let's learn how to do this question together. I'm going to share my Excel sheet. Hold on. All right. So project E. Okay, what you do first? Sorry, it's too huge. Okay. Project E. I think my laptop is like crying out for help already because it's been on for so many days already without me switching it off. Okay, so project B, what you need to do is capital rationing. Right. So to do capital rationing, remember I told you the first thing that you need to do is calculate your PI. So I have project II and initial investment, and he gave me the NPV. Okay guys, remember I told you to calculate profitability index, what do you need? You need present value of future cash flow, and then you need your initial investment. Do you have present value of future cash flow given in this question? No, right? So what you need to do is you need to calculate the PV of FCF. Now, let me just copy the information from the question first. Okay, 2,500, 2500, 2200. I'm just copying the question, merely just copying it. Okay, 2,600, 19 and 5,000, 1,900 and 5,000. Now, the NPV was also given to me, 1,000, 1,550, 1,350, and 1,500, and here is 0. Right? So let me just double check my figures. 1,550, 1,350, 1,500. Okay, so now what you need to do is, okay, you need to calculate your present value of future cash flow. All right. So present value, remember I told you initial investment plus NPV. Copy, paste, and then your PI. PI will be equals to your present value over initial investment. Okay. So I'm just going to make it like this so that it's nicer to see, easier to see actually. All right. So no matter what, okay, when I rank my project, okay, maybe I make it slightly smaller, a bit smaller. Okay, I'll just do ranking here. Then I'm supposed to leave a line, okay, a column. Now, I will always choose project E as the first project. The reason why I choose project E as the first project is because that is priority. Project number 2, project number 3, 4 and 5. Okay, but guys, please remember that the examiner has mentioned project B and project Denmark is mutually exclusive, so you only can choose either one of it. All right, so which one would you choose? You would choose the one with the highest PI, okay, among the two. So the one that you would choose would actually be the one which is project Denmark. All right, you will not choose any other project, or you won't choose project Brazil, because project Brazil actually is giving you a lower PI. All right, now, so when I do my calculation, so this one I will not choose it. Okay, maybe I just draw X here. All right, now, so to find my optimum investment schedule, I do project initial investment, and I do my NPV. Okay, so guys, remember the amount of capital that is restricted is 10 million. So whatever I do, I cannot take on a project that is more than 10 million. I must take on project E, I will take on project D, and I will take on project C. Okay, so if I take on project E, it will be 5,000, D is 1.9, and C is 2.6. Okay, students like to ask me, Miss, why do you stop here? Okay, because I know that if I do a mental calculation, this is lesser than 10,000, but it is not exceeding the 10,000. Okay, so it's lesser than 10,000. So what I do is I will do my calculation here. I would see that, okay, I still have remaining 500 that is left to finish or to complete my quota of 10 million. Okay, so my quota here is 10 million. Now, the next project that I will take is project A. All right, so for project E, my NPV equals to 0. Here, my NPV for project Denmark is 1.5, and my NPV for project C is 1.350. Now, guys, how many percent of the project A am I taking on? So, project A, amount that I'm taking is 500,000. The amount of total investment is 25,000. So I will only earn this percentage of my NPV, which is 200. So the total NPV that I earn is 5.9 million. So if I take on project E, if I take on, or if I have a capital rationing situation, I will take on project E, C, D in full, and I will take on part of project E. So here, the projects that can be, the projects E, D, C will be taken on in full. Only part of project A is undertaken. Right? So guys, I hope that this is clear. Okay, this should be clear. I've covered all bases. I haven't done a non-divisible yet. Okay, if I find a question that I can do with you, if I have sufficient time, I would definitely do it with you. So with this, I end my chapter 11. This wraps up chapter 11, and I will continue to do tutorial on lease or buy, EAC, and also capital rationing, if any. All right, so I will see you in the next video for the tutorial questions.